Hello everyone, and welcome back to Explain the Charts. Today is November 5th, 2025, and we're taking a deep dive into the QQQ, the Nasdaq 100 ETF. The markets are in a fascinating, yet precarious, position right now, with a major tug-of-war between bullish and bearish forces. First, let's cover the news driving the sentiment. Yesterday, on November 4th, we saw the Nasdaq Composite fall over 2%, its biggest daily drop in nearly a month, with the QQQ reflecting this weakness. This tech-led sell-off was sharp and has put traders on high alert, with Wall Street's fear gauge, the VIX, also jumping. However, this comes right after a strong performance on Monday, where optimism around AI mega deals propelled stocks like Nvidia and Apple higher. This divergence highlights the current market uncertainty, where long-term bullish themes like AI are clashing with short-term macroeconomic fears. Adding to the bearish sentiment, we're hearing cautious commentary from some bank CEOs about a potential market pullback, alongside concerns in the crypto and housing markets. Conversely, Nasdaq's own leadership has pointed to a broader return to earnings growth across many companies, which provides a fundamentally bullish underpinning. So, with this conflicting backdrop, let's turn to the charts to see what the price action is telling us. Here on the daily chart, we can see the broader uptrend that has been in place for over a year. The price pushed to a new all-time high just last week, reaching up to the $637 level on October 29th. This established a major resistance zone that the market has now decisively rejected. Looking back, we can identify a significant period of volatility back in April of this year, where the QQQ saw a rapid decline from around $476 down to a low of about $402. That deep pullback and subsequent V-shaped recovery established a critical long-term support area. Now, focusing on the most recent price action, yesterday's candle is a large, bearish red candle that closed near its lows at $619.25. This move signals strong selling pressure and suggests a potential short-term trend reversal. The first key support level to watch is the low from October 10th, right around the $589 mark. A break below that level would be a significant bearish development. Below that, we could look for support in the consolidation area from late summer, roughly between $550 and $565. To the upside, immediate resistance is now the high of yesterday's session at $626.95, and beyond that, the all-time high zone around $637. Let's zoom in on the price action since the beginning of September to get a clearer picture of this recent reversal. As you can see, the uptrend from September was steep and consistent, breaking through previous highs with strong momentum. However, the rejection from the $637 high was swift, and yesterday's drop occurred on noticeably higher volume than many of the preceding green days. Increased volume on a down day is often a bearish confirmation, suggesting that conviction among sellers is high. This is where the news of a broad, tech-led sell-off directly aligns with what we're seeing on the chart, creating a powerful narrative of a potential top being formed. Now, switching over to the hourly chart, we can analyze the intraday dynamics of the recent sell-off. Here we can clearly see the large gap down at the market open on November 4th, with the price falling from a previous close above $632 to an open of $623. Throughout the entire session, the price failed to reclaim that gap, which is a classic sign of weakness. The intraday attempts to rally were sold off, forming lower highs and confirming that sellers were in control for the day. The price eventually bottomed out around the $618.50 level before a slight bounce into the close. Drilling down even further to the 15-minute chart for yesterday's session gives us a granular view for short-term trading. The opening drop immediately established resistance for the day right around the $624 level. After a brief consolidation, the selling pressure resumed, pushing the price to its session low of $618.45. For day traders today, that low at $618.45 is the critical level to watch. A break below it would likely trigger another leg down. Conversely, for any bullish momentum to build, buyers would need to push the price back above the intraday resistance levels, starting with the $624 area and then targeting the session high near $627. So, to recap everything, let's return to the daily chart and summarize the key takeaways. The critical resistance levels to watch are yesterday's high around $627 and the all-time high at $637. The key support levels are yesterday's low at $618, the major psychological level of $600, and the swing low from October at $589. Now for some potential scenarios. A bullish case, which I'd give about a 40% probability in the immediate short term, would involve the market finding support at or above the $618 level. If buyers step in, perhaps on positive AI-related news, a breakback above $627 could signal a move to retest the all-time highs. A bearish case, which I see as more likely at around 60% probability for the short term, is reinforced by the strong downward momentum and negative sentiment. A confirmed break below the $618 support would likely open the door to a test of the $600 level and potentially the more significant support at $589. Long term, the overall uptrend remains intact despite this pullback. A deeper correction towards the $550 to $565 support zone could present a strategic buying opportunity for those with a longer time horizon, assuming the fundamental growth story in tech remains unchanged. Things to watch for will be the follow-through price action today and whether sellers remain in control or if buyers begin to defend these lower prices. Thank you for joining us on Explain the Charts. Please remember, this analysis is for educational and informational purposes only and is not financial advice. You should always conduct your own thorough research and consult with a professional before making any investment decisions.